Rent growth levels have really cooled off in the Chicago apartment market, and that's directly linked to a lot of construction taking place inside the urban core. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons with your Windy City update. Apartment construction has been the big story in Chicago. Take a look at this chart showing overall construction, and you can see that we are at the highest levels in 20 years for the Metro Chicago area. We're just coming off that peak just now. Now, that is a big number, but Chicago's not the only large market seeing construction at a 20-year peak, but it's having more of an effect here than it is in other large markets across the country. And the primary effect has been on pricing. Not long ago, Chicago ranked among the U.S. leaders with year-over-year rent hikes of 4%, 5%, and 6% through much of 2011 and 2012. But we saw a big slowdown in 2013, and that continued into 2014. Just 1.4% growth year-over-year in new lease rents as of Q1 of 2014. That was Chicago's weakest performance in almost 4 years. At the same time, apartment occupancy rates are starting to move in the wrong direction. Occupancy has fallen 90 basis points over the last couple of quarters to a rate of 94.9%, Chicago's worst rate in almost 3 years. So what is going on? Well, Chicago is a market that in recent years has seen an awful lot of construction in the urban core submarkets, the Loop and Streeterville River North. These are areas that saw huge rent hikes coming out of the recession. They really drove up the Metro's overall performance, but they're also the spots that are seeing the bulk of the construction that's occurring in the Metro Chicago area. Take a look at this chart showing annual rent growth versus construction in those two submarkets. You can see those huge hikes in 2011 through the first part of 2012, but then the rent growth numbers start dropping off fast as construction returned remarkably quickly, and as of Q1, rent change was negative in these spots on average, down 2.1% year over year. Obviously a lot of competition for renters given the increase in supply in those areas. Meanwhile, the suburbs have not done much at all to lift the market. Rent growth has been consistently mediocre, essentially across the board among the suburban areas, and occupancy rates haven't moved up especially well, even though supply has been very, very limited across the suburban areas. So what's going on? Well, it traces down to weak demand drivers in some of these spots. In certain areas, the economic story is still very, very weak, while in other spots, there's been a lot of single-family activity, a lot of sales, and also a lot of new single-family rental properties on the market. Chicago is a market that attracted a lot of institutional investors buying up single-family homes and turning them into rentals, and the Chicago metro area just hasn't generated enough jobs to fuel demand for both apartments and for single-family, so that's led to some lackluster numbers. Now, the headwinds that we're seeing now are likely to continue through the first half of 2015. By that point, we should see completions drop off in the urban core. Assuming that happens, Chicago should start to see much improved performance by that point, starting in the second half of 2015. Until then, Chicago's apartment market is likely to remain an underperformer. And that wraps up for Chicago. So until next time, for Apartment Market Dynamics and MPF Research, I'm Jay Parsons. Thanks for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.